Disney is down 5% year to date, but is it a buy now? The Walt Disney Company, $84.16 currently trading in the stock market. Prices which were seen nearly 10 years ago today, meaning if you had picked up these shares nearly 10 years ago, you would have made absolutely zero return. In fact, it would be negative taking into account inflation. But is it a buy now? Can we enter in to the Walt Disney Company at a very undervalued, cheap price? It doesn't offer any dividends. So is it a buy now? Today we're going to run through the historical performance of the company. We are going to take a look at the income statement, look at their revenue growth year on year, as well as that bottom line, that net income, and how that compares to the top line. We're also going to take a look at the health of their balance sheet, look at their cash versus their total debt, and this is then going to lead us on to looking at some very important financial metrics that you need to understand before entering into a transaction of picking up Disney shares. Finally, we are going to look at the end of this episode at the stock valuation model, getting to our intrinsic value and finding out our acceptable buy price given our margin of safety. Now, it is down 5.4% year to date, significantly underperforming the S&P 500, which is up around 15% year to date. As you can see, it is pretty much thereabouts at the 52-week low. And as I mentioned at the beginning of the episode, it is at a price level seen in 2014, nearly 10 years ago, meaning zero or negative return if you factor in inflation. But is this a price right now that we can lock in for very, very significant growth? As we can see here, 37% over the last 10 years. This does depend at which point you did pick up the purchases of the share price, but let's take a look at the financials. Now, in terms of their revenue, the top line, what we like to see, 3 to 7% growth year on year. September 2018, 59 billion on that top line. 5 years later, their latest annual report, October 22, 83 billion. And we can see 5-year growth over the period. However, when we take a closer look, we can see from September 2019 to 2020, their revenue did drop. However, it then didn't pick up. So we will take a look shortly at the 10-year worth of data in percentage terms to make it clearer. Bottom line, however, does it follow the trajectory of the revenue? The top line, September 2018, 12.6 billion on the bottom line net income. October 2022, 3.1 billion. So we can in fact see the direction of the bottom line going the opposite way that we'd like to see as investors. 12.6 billion to 3 billion. And if we take a closer look, we can see here during that COVID year, negative 2.86 billion, meaning they made a net loss in 2020 in their annual reports. And we'll touch upon this shortly when we look at the financial metrics. Now, in terms of the balance sheet and the health, well, I like to look at the cash versus the total debt. What we can see, 2018, 4.1 billion in terms of cash. Latest quarterly report released a few weeks ago, 11.5 billion. So they are holding on to more cash over the last 5 years. Now, directionally, how does that compare to the total debt as well as numerically? Well, total debt, 20.8 billion, 20.9 billion, in fact, in 2018. Latest quarterly report on the balance sheet, more than doubled, 47 billion. So they are holding a significant amount of debt on the balance sheet. And as we can see when we look at the financial metrics, what we want to understand is how does that affect the future of Walt Disney? Straight away, market cap 153 billion, making a mega cap company. Now, something to note about the dividends. As mentioned earlier in the year, Disney does expect to reinstate a modest dividend by the end of 2023. Now, the year is flying by, so we should hear about this over the next few months to see what sort of percentage we are looking at as dividend investors. Now, hypothetical projections based on the forward earnings per share of 374 and their payout ratio. This could be anywhere between a 0.44% yield to around a 2.62% depending on their payout ratio. Now, what we can take a look at, if we just go through to the previous years in what their earnings payout was when they did pay a dividend, it was around 20 to 30%. So when we take a look at the hypothetical projections, between 20 to 30%, we are talking about a 0.87 to a 1.31% yield. So if you wanted to make it a nice easy round number, In my opinion, around 1% yield is what I believe they will be offering from the end of this year going into 2024. Now, in terms of the dividend growth, as we can see, for investors that didn't know, Disney did pay a dividend up to 2019, as we can see. However, they did cut that dividend in 2020. You could attribute quite a lot of that to COVID and the lockdowns of the parks, which makes up a significant portion of their revenues. Now, as mentioned, in terms of their earnings payout and their free cash flow payout, personally, I do prefer to look at the free cash flow in any type of data when you research companies. Earnings payout is susceptible to manipulation by management through their accounting. So always, if the data is available, do look at free cash flow, whether it's free cash flow payout or free cash flow per share. However, we can see they were paying around 20 to 30% year on year consistently. Now, what we can see, in fact, one thing to mention, 2019, when they were paying that dividend, the reason why you could argue they did cut the dividend, their free cash flow as the parks dropped, they were paying out 168% in their free cash flow in dividend due to the drop in their revenue, and therefore they would stop and cut that dividend. Now, in terms of their earnings per share versus free cash flow per share, as I mentioned, I'll talk about the free cash flow. For those investors that like to look at the EPS, do look on the left. So free cash flow per share, 371 in 2013. Up to 2018, there was some nice growth over that 6-year period. However, once lockdown came, we can see here it did significantly drop from 656 all the way down from 2020 to 59 cents. So you can see a significant drop from 2013 at 371 to 59 cents in 2022. Now, it is expected in 2023, when the annual report is released at the end of the year, to be around 495. Now, it's not as high as the pre-COVID level, but it is making its way there. But do bear in mind that currently their free cash flow per share is significantly lower. Now, moving on to the sales growth, typically we like to look for 3 to 7% growth year on year. Again, you could attribute the negative 6% in 2020 to the COVID lockdown. But other than that, they did seem to hit that 3 to 7% target year on year, other than 2017. Numerically speaking, 45 billion worth of sales in 2013, 83 billion in 2022, nearly double, consistent increases year on year. Now, in terms of the shares outstanding, typically as investors, we love it when companies do share buybacks, returning excess cash to our shareholders. 2013 to 2018, if the graph ended there, it would be good. They would be doing share buybacks. However, 2018 to 2022, they in fact did the opposite, diluted your position as a shareholder, and in fact did the opposite and issued shares. We can see it did slow down in 2021, where it remained flat over the next year. But do bear in mind, if a company has done it once, they are more than likely to do it again if needed. ROIC, return on invested capital, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. Now, the reason why I like around 10% is it gives me faith that management are able to effectively allocate their capital. What we can see here from 2019 onwards, it effectively has dropped below 10%. Slight worry, so I would be looking at 2023 to see above 4% moving forwards. Operating margin, free cash flow margin, again, tell a very similar story. 2013 to 2019, we can see an operating margin of around 20% plus. Likewise with the free cash flow margin, around 13 to 17%. However, from 2019 onwards, we can see the dramatic drop in the free cash flow margin as well as that operating margin and beyond. So again, we do need to see 2023's annual report where they have had a good year to see whether or not that has affected the data in a positive manner. Now, net debt to earnings for interest, tax, depreciation, amortization tells us the number of years it would take the company to pay off all their debt net of cash on hand. We like to see around 3 below. So what we can see here, 2020, 3.53 years, 21, 3.42, and 2022 going into the 2s, with expected 2023 to be 1.93. So whilst it may have been a red flag indicator when we looked at the balance sheet review, it does seem to be that this number is coming down, so they are paying off that total debt. But again, something to keep a close eye on given how high it went in 2020 to 2021. On the right is just showing the number of years, as we can see here in 2022, the percentage. So 2022 shows 27% of the company's financing is from debt as opposed to equity. Now, moving on to the valuation model. As always, if you are enjoying the content, do hit that like button, do subscribe and join the community for these stock videos. And as always, if you want to grab a copy of the valuation model, do check the pinned comment and grab a copy. So we'll start off with Graham's valuation model, where we have the stock ticker DIS, earnings per share at 124, with the growth rate per analyst estimates at 40 and that yield on AAA corporate bond at 4.99. This gives an intrinsic value of $51.39 for Disney. As we can see here, well below the 52-week range and significantly below the current trading price, showing significant signs of overvaluation based on Graham's valuation model. Now, the second model, the multiples valuation model, companies in a similar sector and size. We have Netflix, Nike, and Lululemon with the stock price, earnings per share, and PE multiples. We get the average and multiplied by the earnings per share and gives a multiples valuation model price of Disney at $51 again, showing signs of significant overvaluation and well below that 52-week low that we can see on screen. Now, we then move on to the third model, the dividend discount model. And if you remember, they currently do not provide a dividend. But what we can see here, based on the previous data, the growth rate over the 2-year period. Now, in terms of the average growth rate, as we only have this data, what I have done here is taken the average of the 2 years that they did pay a dividend, as I do believe, as Bob Iger, the CEO, mentioned, they will be paying a dividend towards the end of the year going into 2024. Therefore, I've gone with 6.25%, which is the average based on the 2 years. You could justify lower. Again, you could probably justify higher if you have the data to support that. As always, if you want to play around with this, do check the pinned comment and grab a copy of the model and play around. But based on the estimates and judgments of the video so far, the DDM price comes to around $107, as we can see, showing some nice signs of upside and still within that 52-week range. Now, moving on to the fourth and final model, the discounted cash flow model, we have the free cash flow year on year for Disney. Average growth rate at 9.55%, with analysts anticipating an optimistic 14% moving forwards. Now, combine that with the discount rate at 8%, we get the present value of future free cash flows and terminal value. Add that with the cash, subtract the total debt, and we arrive at our equity value. Divide that by the shares outstanding, gives a DCF price for Disney Company at $130. Again, nice signs of upside to the current trading price and slightly higher than that 52-week high that we have seen. Now, the intrinsic value is essentially the average of the 4 models we have just gone through. And as always, if you are enjoying the content, hit that like button and do subscribe to join the community and continue receiving these videos on your doorstep. Now, essentially for the stock valuation model, whilst we have run through these 4 models, personally, I have removed Graham's valuation and the multiples valuation model. I don't believe Graham's valuation model to be essentially appropriate for Disney, and for the multiples valuation model, I don't believe the companies that we did use were essentially that accurate to be included within our intrinsic value calculator. Therefore, the intrinsic value is the average of the discounted cash flow valuation and the dividend discounted model valuation. Now, as always, if you do believe that you can justify using all 4 models or only 3, do grab a copy in the link below and do play around. So the intrinsic value we have calculated based on these 2 models comes to $118, as we can see, showing some nice upside to the current trading price and essentially bang on there at that 52-week high. Now, current price around $84.39. Typically, margin of safety, I'd go for 10% if it was a strong financial metrics company that we've run through, a wide moat, and good forward-looking data. Now, for Disney, I would suggest a much higher margin of safety than 10%, so I would say a minimum of 20%. Now, what this signals, if you wanted a margin of safety of 20%, based on the estimates and judgments of today's episode, you'd be looking for an acceptable buy price of around $95. Now, for those who are looking for a 30% margin of safety, your acceptable buy price would be around $83, a dollar and a bit just off that current trading price. So Wall Street forecasts the price over the next 12 months to hit around $110, showing some nice upside to the current trading price. So what this essentially means, if you were to enter into this transaction at around $83, you would, based on today's video and estimates and judgments, be getting a margin of safety of 30%, with some nice upside based on Wall Street analysts of up to $110. As always, let me know your thoughts in the comments below. Are you looking to add Disney to your portfolio? Are you looking to sell, or purely just a speculator on the sidelines? As always, like, subscribe, join that community. don't forget to hit that like button. And as always, if you want to grab a copy, do check the pinned comments and play around with the valuation model. As always, have a great day and take care.